Hey everyone, me Kevin here. Boy oh boy, the market had some pain today. Wow wow wee wow, look at all the red. Oh my gosh, Unity, Xpeng, Moderna, Cloudflare, Blink, Tesla, Fastly. Oh my gosh, Shift, Zoom, Peloton, you name it. We've got lots of these high-flying tech and EV names just going today. And what the heck is happening? Well, the first thing I can tell you that's happening is you can still get 4 free stocks with Webull, which is that platform right there. Deposit $100 and you will get 4 free stocks worth up to $1,600 and at minimum $21. It's in the link down below right next to the link for life insurance you can get in as little as 5 minutes. All right, in this video, I'm going to talk about major market catalysts coming up, what they could mean for our money. And remember, catalysts are things that can usher in a lot of good or a lot of bad really fast. So we got to pay attention to these. Before we hit these though, I'm going to talk about major news. So what we're going to do is we're going to hit stock news, then the dangerous catalysts and the good catalysts, and then we're going to talk about what I'm doing with my money. Let's get into this. First, Congress can't get their act together on stimulus, with Mitch McConnell pushing for $600 stimulus checks without any kind of federal unemployment boost, but coming up from $500 to $600 billion in spending to $900 billion, which should be seen as a positive impact and sign for the market, but no, the market is concerned that we are entirely out of time to get this bill done or to get any stimulus done, and that leaves people concerned that maybe the government is going to shut down again and we'll have some volatility because of a government shutdown. Next Friday, the 18th, is the deadline for Congress to get their work done, and it is also Quadruple Witching Day, which is a day known for substantially increased volatility. Then JP Morgan released multiple new price targets today, pretty much slamming anything that we generally like. Analyst Sterling Auty mentioned in a 151-page report slapped together by JP Morgan that it's time to shift out of software stocks like DocuSign and Zoom, saying, quote, "We are turning too bullish on these cyclically sensitive software stocks." He says that there is going to be a tremendous year ahead for software, but that valuations have gotten so significantly expanded that as the economy goes back to normal, expect investors to rotate out of these pricey stocks and into the reopening stocks. At the same time, JP Morgan sees next year as being great for stocks in general as volatility goes down, and says that we should be buying Hostess stock. Yes, the manufacturer of Twinkies. They also go on to say that Bitcoin will rob gold of returns as people leave gold for Bitcoin. Now, JP Morgan did also suggest that we invest in a stock that I've actually been eyeing, and that is Wix, which I'm planning a video on Wix and Shopify. Both of these are stocks that have pretty much done nothing over the last 3 to 4 months, and these might be an opportunity to take advantage of some sideways trading, but not without us considering the big catalysts coming up. In other news, DoorDash went public today, taking advantage of his latest surge in sales, which is actually like the most brilliant time for DoorDash to honestly go public, right at the pandemic heights when everybody is actually getting used to using DoorDash, and hey, it's a great service. Though many question its insane valuation, which it seems to be like 5 to 6 times as pricey as Grubhub. And with a share price of now somewhere around $187 per share here at the closing bell, slightly over what the shares opened up for at $182 for IPO pricing, DoorDash is just too rich for me to touch. Instead, I'm going to focus my attention on Airbnb. That is, of course, if I can get my hands on Airbnb for under $105 a share. I made a full breakdown of my thoughts on Airbnb. You can check those out. Just type into Google or YouTube, Meet Kevin Airbnb. Then Great Britain warned against the use of the Pfizer vaccine for those with a history of severe allergic reactions, as 2 healthcare workers had adverse reactions to the shot, manifesting anaphylactic reactions to the shot. But those are not good. See, the thing about vaccine news is any good news on the vaccine tends to pump stocks decently, but if there's bad news, quite the opposite could happen, and that's not necessarily to the benefit of even stocks like Carnival or Delta Airlines, which are both down today. In fact, sometimes what can happen is people just get fearful over the market in general and start pulling their money out. Now, on another note, JP Morgan also decided to slam Tesla. There is a particular bear analyst at Tesla who has raised their price target from $40 to $80 at Tesla, but Bloomberg aptly pointed out that this is somebody who, well, let's just say if somebody had been following this person's advice, they would have returned over negative 800% this year. However, this person, while they did increase their price target, I think we all realize $80 for Tesla is kind of a slap in the face and almost a little bit laughable. Now, usually I wouldn't want to come across as saying that somebody's opinion is laughable because anything can happen in this world. Absolutely anything can happen. And after all, if we do 80 times 5, that's $400. And it wasn't long ago that Tesla was priced at $400 with its pre-split pricing. Now, personally, I don't see that happening, but if that happens, I will sell all my real estate and plow everything right into Tesla stock. But hey, who knows? Maybe this guy will be the king of investing next year. Now, do keep in mind the S&P 500 inclusion is going, in my opinion, to be a setup for a lot of pain in Tesla stock. I'm not actively buying Tesla stock right now, other than in my 1337 portfolio, which we'll talk about later, because I've got a big update for that one. There I've got about a 7% weight for Tesla right now, which is lower than my usual weight for Tesla, and that's because I'm expecting Tesla to have some red coming up shortly after that S&P inclusion. But anyway, let's go ahead and jump on over to Quantomscape, and then we're going to get into some of the big market catalysts here. Quantomscape is a stock that shot up about 50% yesterday and 30% today. This recently listed stock via merger announced a potential battery breakthrough yesterday, suggesting they may have solved a solid-state battery technology, something that Tesla has not done or announced even on their battery day. In fact, Tesla has not mentioned solid-state technology as something that they have figured out yet, even though we know that solid-state technology for batteries is something that we think as investors could finally get energy pricing to below $50 per kilowatt hour, which would be an absolute breakthrough for battery technology. Quantomscape believes that their batteries might be able to achieve this and might be able to recharge 80% capacity within 15 minutes with no battery degradation for enough cycles to drive 250,000 miles. Now note, degradation is different from lifespan of battery. A battery that doesn't start degrading until 250,000 miles could easily last over 1 million miles, maybe even 2 million miles. Now, as far as Quantomscape's battery technology goes, it's only lab tested right now, so it's potentially true that there's a lot of hype around this, but we don't yet know how these batteries are actually going to perform in real battery packs, let alone in actual vehicles. However, this is very promising for the future of electric vehicles and honestly anything that uses batteries. Anything that gives us breakthroughs in battery technology is very important. We just did an analysis on the channel here about nano dimension the other day about how, look, nano dimension 3D printing for these flexible technologies in the future might be great, but we're gonna have to shrink battery technology a lot to, in my opinion, really get these 3D printed circuit boards mainstream, and then we still don't know if they'll actually be 3D printed. Now, I've added Quantomscape along with Nano Dimension to my targets to watch, but right now I haven't put any money into these stocks, but they are definitely sort of in my scope, so to speak. All right, so these are some of the headlines. Now let's go to catalysts, and some of these things are good to know. We gotta address these. That's why we've got some additional market volatility today, but let's also look at some catalysts. First, we've got two good catalysts. We expect the FDA to grant emergency use authorization for the Pfizer vaccine tomorrow. Moderna's EUA, emergency use authorization, could come soon afterwards, maybe the same day, maybe it'll come next week, we'll see. And then we are also within $140 billion of a stimulus deal happening that could be completed by December 18th. Now, these are both good catalysts, and after all, a stimulus package, by the way, is expected to include $25 billion in rental relief, 90% of which should be going to tenants for back rent, which would be a phenomenal relief of $22.5 billion to get tenants out of the hole. But those are the good, but what about the bad? All right, well, to understand the bad, remember this. Before the election, remember how much the market freaked out leading up to the election, like the 2 weeks before the election, and even in September leading up to the election? November 3rd was election day, and the market had some major concerns that we were going to lose control of our country, there were going to be mass riots, a surge in COVID cases would tank the markets, and Democrats were going to take over and destroy everything because they would raise corporate taxes and raise individual taxes, and Democratic priorities would be set through, and oh my gosh, a lot of bad things would happen. Well, then the election happened, and as usual, our expectations are usually a lot worse, and reality is usually better. Now, I know that's ironic because usually when we do expectation versus reality, we expect things to be really good, and then they turn out not so good. But in the stock market, we tend to overvalue how bad something is going to be, and reality tends to be better, ironically, when we're looking at it from a negative POV. If you're expecting stocks to be really, really high, oftentimes that's when that's when things will fall short in terms of expectations versus reality. And the most recent example of this was, well, the election. After all, if you invested before the election, you enjoyed a really, really nice November. November felt a whole lot like August, where the market just went up and up and up and up to the point where I was writing messages in our Discord chat in the private stock group where I'm going, what the F? This is what Lemonade stock's doing? And some of my other favorite large investments are like doubling so fast. I'm like, what's happening here? This is not sustainable. All right, so what do we have in terms of catalysts in the event that we are going to shift into a larger or broader stock market sell-off? What is driving the market down? All right, number one, uncertainty over the January 5th election. January 5th is that date where we will determine who controls the Senate, Democrats or Republicans. Again, right now, it looks like the Senate is going to remain Republican controlled with 49 Democrats and 51 Republicans. But if Democrats get both of those seats in Georgia, that could usher in those higher corporate taxes, higher income taxes, and other Democratic priorities. That is a concern for markets, whether or not those things will actually happen. Number two negative catalyst, hedge funds may start taking profits now before their profits evaporate. That way they've taken advantage of the profits from November. They can lock those in on their balance sheets. And when it comes to marketing next year, these hedge funds will be able to say, look how much money we made in 2020. Come invest with us. You want to take advantage of maximizing your marketing opportunity by selling and waiting rather than, rolling the dice, so to speak, on what could happen over the next 3 weeks. This is very common. The end of the year profit taking at hedge funds, super common. Number third negative catalyst, hedge funds may end up just moving to bonds, take money out of the stock market and park it over into bonds, which would mean it's not going to come back at least until new money starts coming around. Although you've got Ray Dalio who's going, look, there's no shortage of cash right now. There's a lot of money on the sidelines waiting to get in. He might be right about that. Although Ray Dalio does think there's going to be a great deleveraging and a great reset when everybody decides, that's it, I'm paying off all my debt, I'm selling all my assets, and basically we're going to have the biggest collapse ever. We'll see. That might be a topic for a different video. Number four, negative catalyst. COVID cases continue to skyrocket, but honestly, at this point, nobody really cares about COVID cases. I think the biggest issue, though, could be COVID deaths. COVID deaths could easily reach 3,000 to 5,000 deaths per day over the next couple months. That is more than a Twin Tower-sized loss every single day of humanity in the United States. That could potentially pressure the markets, although lately COVID cases have done nothing to impact the stock market. Negative catalyst number 5 is the increasing risk that Congress does not actually pass a stimulus package, leading unemployment benefits to expire completely, leading to the start of the eviction crisis and ultimately a government shutdown. Whew. Now, that's a lot of negativity, like a lot of negativity. But the odds are we're not going to see all of this negativity come true altogether. And even if we got a good chunk of this negativity, like stimulus doesn't happen, or, we get this eviction crisis that starts coming about because stimulus doesn't happen, at the same time the government shuts down for a bit, the odds are the economy is probably going to be okay. I don't see any of these as more than short-term issues that are all of a sudden going to cause a foreclosure crisis and destroy the entire stock market. Now, that's partially because as we expect a likely Biden administration to take over, barring any kind of insane turnaround in the courts for Donald Trump, it is likely that we will see Joe Biden push for dramatic intervention in the form of eviction response and aid, unemployment aid, state and local aid, and a lot more of a stimulus priority. That is, I expect anything Republicans want will get held up in exchange for more stimulus support by Biden and Democrats. So I think this is going to sort of dampen damage that might be caused in the first 6 months of next year. Though remember, we are expecting a recession in the first few months of next year, thanks to a lot of the new lockdowns that we've got going on. Heck, you've got Southern California, or parts of Southern California, like the county I live in, going, dude, why'd you lock us down, California? Because California is mostly locked down. Ventura County's going, dude, cut us out from LA and all these other counties. We're doing okay. It's crazy, but it goes to show there's some massive damages and fears over lockdowns right now, and people don't want to be locked down because there are economic consequences of that. But more importantly, when we look at something like the eviction crisis, and I try to go deep into understanding how bad could these things really get, look, we might see a recession. I think the market's expecting that. We will see a lot of sales come up because of an eviction crisis if we have an eviction crisis. But when it comes to an eviction crisis, I personally don't see prices in real estate falling, but maybe 10 to 15% in the short term. but I wouldn't be surprised if 2021 ends the year flat, including an eviction crisis. I think there's too much equity in markets now. People have too much money in their homes for us to actually see a real foreclosure crisis, especially with homeowner forbearance still being an option for people, as you could still today take 12 months of forbearance and not make any payments. So instead, I think we're going to be left holding this bag of fear for the next few weeks. And this is going to be a really big bag of fear that I don't think is going to explode in our faces next year. If anything, I think once we get into January and February, the market's going to be a whole lot more chill. Now, we might see a rotation in what people decide to invest in, but I definitely think we're going to see the fear indices lower. We're going to see emotions chill in February and January even, as things finally get back to some semblance of normal. And so this is where I kind of get to what my strategy is now. And this is something that I've been talking to my course members about for the last few weeks here, is that stocks are very frothy. You know, people regularly ask me, Kevin, what's your buy target for something? And a lot of my response is, look, right now you've got to wait. You got to wait for things to get a little bit more reasonably priced. Things are expensive right now, unless, of course, you want to dive into like a broad-based sort of investment strategy where you're investing into maybe 50 different stocks, something like that. And so my goal is to get about a good chunk of money invested in the market over the next month. Like, I could see myself putting $1 million to $1.5 million into the market in this next month, which sounds insane, but that would increase my stock market portfolio about 10%. And if I do this, and I use margin on some of this, which is risky, I will be at a total of 18% margin, which my goal would be to only draw this in the short term and then pay this down in January and February. So that way I'm fully invested going into 2021, and then I'm just going to ride and pay off that margin again. I got my margin down to as low as about 4 to 5%, and I bought some properties and I've slowly been pulling it back up again. I don't want to exceed 18% of my total portfolio, though. And that way stocks would really have to fall at least 70% for me to even start getting nervous about my margin. And I just do not see a 70% pullback in the horizon. Even when we had the March 23rd fall, the market fell like 50%, right? So 18% margin, I'm comfortable there. Margin is risky, so don't get me wrong, that is an issue. But that's my POV now, is I'm gonna try to pull forward some of my earnings now, invest as much as I can this month, especially if we get weakness over the next 2 to 3 weeks. I'm going to be buying. And I'm going to be buying a lot. And I'll be posting alerts in terms of what I'm buying in the private stock group, which you can join if you join the stock group and the psychology of money, and that link down below. There's a coupon code down below. You can also email me if you want a bundle up coupon, kevin@bkevin.com. Keep in mind, this is not a day trading course. It is a building wealth with stocks course, fundamental based stock course. Maybe in the future we'll add trading. And if I do, it'll be included for free, but that's not what it is right now. So for me, I see fear plummeting over the next few months, and that's why I want to get invested in the market as much as possible. Now, I will say I'm not jazzed about buying individual stocks right now outside of a portfolio, because I think everything's a little frothy. So instead what I'm doing is I'm investing in, you could go to this, type this into your browser, metkevin.com/1337V16. Now, I've totally re-engineered this sort of 1337 portfolio to where now what I've done is I've grouped things by sector. I'm planning on updating this a little bit to V17. So some things here might be a tiny little bit different from what you'll see on V16, but there'll be minor differences. But anyway, the goal is, this is kind of the spreadsheet that I'm using, is I'm putting 25% into consumer and retail stocks, and you can see how I'm dividing these right here with the percentages below. So this circled in red here is portfolio-wide, and then over here, this would be sector-wide. So for consumer and retail, for example, I'm putting 13% of my money into Lemonade, which Lemonade just blew up in the last week and a half here. Shift has not blown up yet, but this is an opportunity for me to keep putting money into Shift, because I expect Shift will blow up in the future. So we're putting about 12% into that. Then, you know, the Etsy, the Pinterest, the Shopify, and so on and so forth. Then you can see I've got 17% going into the EV stocks. We've got Tesla, NIO, Xpeng. We've even got Enphase in here for the energy aspect, Fisker. Fisker's barely anything in here. This is a pretty tiny play, and honestly, I might even drop them from 2% to 1% within that sector, which only has them about 0.3% in my portfolio. They're like in the carnival region. Then I've got tech. You know, actually, I've got most over here in DocuSign, Cloudflare, Fastly, Ubiquity, Upwork. Snowflake, so on and so forth over here. Zoom's actually the smallest in this bunch over here. Then, of course, we've got the Apple, the Netflix, the Amazons, the Redfins. Housing was the only thing that was green today, by the way. Redfin, we've got the SPAC for Open Door, the social capital SPAC. We've got bio in here, mostly bio, not in anticipation of vaccine approval, but because of the future of mRNA technology. I think this is going to be a game changer over the next, honestly, 10 to 20 years. Recovery stocks, this is it. Honestly, I'm very, very, very smallly exposed to recovery stocks, so I'm keeping those pretty small. But anyway, you can look at this in more detail. Just go to metkevin.com/1337V16. If you invest in that pie, I do not manage your money for you. You have to deal with it yourself. But it is cool because, like today, for example, I put 100K into the market, into exactly what I showed you here, roughly exactly this. I put it into the 1337 pie. And they automatically, here, you know what, I'll pull it up. So look at this, with one button push, I put 100K into the market, or here it says 99.998K into the market, and it automatically spreads my money into all of these different investments with one click of a button, which is really cool. Like Etsy, for example, got $2,900 of that. Beyond Meat got $2,200 of that. Palantir got $1,700 of that, right? So that way I'm not so heavily exposed to individual fluctuations. Tesla got 11%, a little bit higher than I expected it would put in for this portfolio. 2,700 for DocuSign, Salesforce 2,200, Shopify got 2,400. So you can see, I mean, like this would take a lot of work to do this manually. And I briefly actually closed my 13, and actually, what is eBay? Oh yeah, see, eBay barely gets anything. They got like $257. Yeah, sorry, eBay. I personally think that's really cool. I tried going, and I'm just gonna be transparent here. I tried to go without M1 Finance because I brokerage transferred over to JP Morgan. And by doing that, my M1 Finance account automatically got closed. So I've only recently opened it up again. We could go over here and you can kind of see the current, it's obviously down today about 2%, but that's okay. I like buying on those days. But anyway, yeah, when I was over at Just Chase and Robinhood and Webull, which I love all those platforms, I use all of them for specific purposes, but I tried, I'm like, all right, I'm going to buy my 1337 portfolio, and I'm sitting there trying to manually go through. I'm like, all right, I just bought 3 of the 1337 portfolio. How many do I have left to do? Oh my gosh, another 51? This is a drag. So I have to say, like, in terms of actually buying a broth of stocks, sort of a basket of stocks, M1 Finance does a great job. Anyway, so check that out, metkevin.com/1337V16. That's the version we're on right now. And then when I tweak them a tiny little bit, you can always adjust manually by going up or down on the percentage basis. But so these are my thoughts. The market has a very good likelihood of pulling back a bit more over the next couple weeks. It is possible that this could be the start of a market decline. But then again, who knows? I mean, look at Starbucks. Starbucks at all-time ever highs at 103. So in after hours, you've even got some green going on here. Rocket Mortgage up again. So that's nice. It almost looks like we're going to be seeing some people using these as buying opportunities to buy the dips. Tesla down in after hours a little bit more. Redfin giving back basically what it went up today. Quantomscape coming down about 4.5% as that battery hype is wearing off. Hey, let's see how much that thing falls, and maybe that's an opportunity to buy again. It's kind of like when NEO and Xpeng ran up substantially, in November. We knew at some point they would come down off their highs again, and when I mentioned it on November 30th, maybe I got lucky on the timing, and the very next day, those suckers started selling off for a week. And so, stay frosty out there, get in on the red, don't panic on the red, buy on the red. It's like, when you see the red, it's like Black Friday sale, cheaper pricing. All right, everyone, thank you so much for watching. Consider checking out the programs linked down below. Email me for a bundle coupon at kevin@meetkevin.com.